Welcome back to the deep dive. You're here because you need that shortcut, right? The clearest analysis of these really complex market mechanics that, drive huge trading volumes in ways you might not expect.
Exactly.
Today, we're going to cut right through the jargon. We're tackling a foundational action, something that happens deep in the financial world's plumbing that dictates billions of dollars of activity on highly predictable dates.
And we've synthesized a whole collection of sources for you today. We're going to peel back the layers on this one mechanism, moving way past the simple definition to explore the deep structural needs of institutional finance.
So our mission for you today is to really get you to a point of mastery on this concept of rolling contracts.
That's the goal.
Okay, let's unpack this then. Our sources, they really zeroed in on what seems like a simple, almost an administrative task in investing. It's called rolling a contract.
Yeah.
It sounds totally benign, but as you said, in structured finance, this is a non-negotiable requirement, and it sets off these massive, concentrated trading events.
It really does.
Uh-huh.
So our objective for you today is, let's say, threefold. First, we want you to understand the precise mechanics of the roll. What you actually sell and what you buy.
Okay.
Second, to grasp the core motivations. We're going to look at the two big ones: a preference for a specific duration and market liquidity.
And the third.
And third, to analyze the inevitable result, this collective market behavior that this predictability causes, which traders know as congestion.
Let's lay the absolute foundation first then. What is the technical definition here? The source material says very clearly that rolling a contract means trading out of a contract that you hold.
Right.
And then buying the contract with the next longest maturity.
And that is the core engine. But the why is everything. The goal is the whole point. This whole maneuver, this two-step process, is all about maintaining a position with what the market calls constant maturity.
Constant maturity.
That is the key phrase you need to remember today. You're not just, closing one position and opening another one randomly. No. You're systematically engineering your portfolio to, in a way, resist the passage of time.
Okay, so that idea, this constant maturity requirement, that's where the real complexity begins, isn't it? I mean, why are fund managers so fixated on this, on maintaining a stable timeline for their positions? Why not just let a contract expire, let it mature naturally?
Well, it's a mathematical and a risk management imperative. Think about it. You have a bond or maybe a derivative with a fixed expiration date. Every single day that goes by, the maturity of that contract gets shorter.
Sure, makes sense.
And that isn't a minor detail. It fundamentally changes the financial characteristics of the instrument. Specifically, it changes its sensitivity to things like interest rates.
So we're talking about duration here, aren't we?
We are absolutely talking about duration. It's probably the most critical measure of a fixed income security's price sensitivity to changes in interest rates. I mean, a 30-year bond is way, way more sensitive to a quarter-point change in rates than, say, a 6-month T-bill is.
Right.
So when a 5-year contract just naturally ages and becomes a 4-year contract, its duration shrinks. And this means its volatility changes, its hedging characteristics change. If an institution's entire mandate is to hedge against long-term risk, letting their contracts drift shorter just makes their hedge. Well, it makes it ineffective over time.
So if I'm an investor and I started out wanting a 5-year position, after 2 years, I suddenly find myself holding something with a 3-year risk profile. That's completely different from what I originally intended.
Precisely.
So the constant maturity rule is the action that actively fights against that time decay. It keeps the risk profile static.
It's even more than just fighting time decay. It's also about managing something called convexity. Convexity, to put it simply, it measures how the duration of a bond changes as interest rates themselves change.
Okay, so it's like a second-order effect.
That's a great way to put it. And when a bond or a contract gets closer to maturity, its convexity generally drops a lot. So by rolling into a longer-dated contract, they're essentially resetting that convexity profile, making sure the portfolio behaves predictably when rates get volatile. For institutions that are modeling these incredibly complex risk metrics, stable duration and predictable convexity are absolutely non-negotiable.
That makes the whole process sound less like speculative trading and more like specialized portfolio maintenance, like a systematic scheduled adjustment.
That's exactly what it is. It's a foundational part of the portfolio management process for huge players.
This leads us right into section 1, the core mechanic, why constant maturity matters. So we've kind of established the mathematical why. Now let's really focus on the how and the specific market mandates that are driving all this action.
Yeah, and if we connect this to the bigger picture of institutional investing, this idea of constant maturity, it isn't just a preference. It's a necessary input for all their sophisticated risk models.
What do you mean by that?
Well, large investment banks, pension funds, asset managers, they all use standardized duration targets to calculate their capital requirements, to stress test their portfolios, and to maintain something called asset liability matching. Without a stable duration benchmark, their whole risk framework just kind of collapses into guesswork.
Let's get really explicit then and deconstruct the physical action just as the source material laid it out. It's that two-step maneuver, right?
Yeah.
And it's executed almost at the same time.
Right. Step one, you sell the existing contract. This is what's called the nearby or the front month contract. It just means it's the one whose maturity is getting close.
So its duration has dropped below their target.
Exactly. So that contract gets liquidated because its risk profile just doesn't fit the mandate anymore.
And then step two is immediately purchasing the contract with the next longest maturity, the deferred or the back month contract.
Yes, and that immediately resets the position right back to the desired duration.
And the result, as we've been saying, is this consistency in market exposure. The fundamental risk the investor is taking, let's say it's exposure to 5-year interest rate shifts, that risk stays stable, even though the actual piece of paper, the instrument they hold, has changed.
It's a continuous, active repositioning to neutralize time.
So now we can dig into the motivations. Our sources cite two main reasons for going through all this effort. The first one is having a special preference for a specific maturity.
And the source gave a really specific and I think a very insightful example here. It was preferring a specific rate, like the 5-year CDS rate of a given name.
Okay, let's break that down. CDS is a credit default swap. It's basically insurance against a company or a country going bankrupt, right?
That's it. It's a derivative that's used to transfer credit risk. For the listener, a CDS contract is pretty standardized. You pay a premium, like an insurance premium, every year. And if the entity you're insuring, say, a big corporation defaults, you get paid out.
But why the 5 years specifically? Why is that so important that you would constantly be rolling contracts just to maintain it?
Because the 5-year maturity is the international standard, particularly in corporate and sovereign credit markets. It is the most liquid, the most quoted, and the most heavily referenced benchmark maturity on the entire planet.
Wow.
Banks, institutions, they use the 5-year CDS rate for more than just trading. They use it for crucial functions like marking their books to market, for regulatory reporting, for calculating counterparty risk. It's the lingua franca of credit risk.
So if a huge global bank is using a CDS rate to hedge its exposure to, I don't know, a major European bank, their hedge has to be anchored to that 5-year mark.
It has to be.
If they just let it drift down to 3 years, the hedge is no longer aligned with the market standard. And that complicates everything from their accounting to their regulatory compliance.
You've got it. If you're managing a portfolio of credit risk, your goal is pure credit exposure. You don't want duration risk messing with your models. So by constantly rolling, you isolate the credit risk from the duration risk. You are ensuring that you are always, always measuring the cost of 5 years of protection because that's what the market fundamentally cares about.
So it's a standardization play.
It is. It's driven by both market convention and, frankly, regulatory necessity.
That makes perfect sense for something specialized like derivatives.
Okay.
But the second motivation our sources pointed to is much broader. It touches on this universal need in finance. Liquidity. The desire to hold a security that is on the run because it is more liquid than off-the-run securities.
And this is where the role moves from being a specialized necessity to a full-blown mass market phenomenon. Liquidity, as we all know, it just means lower transaction costs, tighter bid-ask spreads. For huge institutions, even a tiny, tiny saving per trade can translate into millions across a whole portfolio.
And when you're managing trillions, prioritizing liquidity is just paramount.
Absolutely, and that simple distinction, the one between the most current security and the one that's just slightly older, that's what creates this huge liquidity difference. It might seem arbitrary to an outsider, but that difference dictates trading behavior all over the globe.
It really does, because in so many of these standardized markets, the newest issue of a security or a contract, it just instantly attracts the deepest pool of buyers and sellers. And often that's because it's the easiest to locate and use for things like short selling, for collateral, for hedging.
Which brings us perfectly to the most visible example of the role in action, the US Treasury market.
This is where it gets really interesting, because now we're focusing on the market behavior that this constant maturity mandate creates, especially this idea of an on-the-run premium. So this is Section 2, the concrete example US Treasuries, on the run versus off the run.
The US Treasury market, I mean, it's the deepest, most liquid market in the world, and it perfectly illustrates the financial incentive to roll your position. The Treasury Department's issuance is highly structured, very predictable. They hold auctions at regular intervals for 2-year notes, 10-year notes, 30-year bonds. It's like clockwork.
So let's set the scene. An investor might want to hold only the most recently issued security of a given maturity. So my question is, why? Why does the simple designation of being the newest carry so much weight?
Because that newest security, the on-the-run security, is immediately established as the market benchmark. It is used in nearly every transaction involving financing, collateral, and trading strategies globally. It becomes the most actively traded security of its duration, which results in these razor-thin bid-ask spreads and just a massive depth of market.
And at the exact same moment, the older security gets, what, downgraded?
In a sense, yes. It becomes the off-the-run security the second a new auction happens. Now, functionally, it's still an obligation of the U.S. government. It has virtually identical credit risk and cash flows as the new bond, apart from a tiny difference in time to maturity.
But its liquidity profile just falls off a cliff.
It shifts dramatically overnight.
Okay, this is a really crucial point for you to get. 2 U.S. Treasury bonds might have coupons that are only, what, 1/16% apart. Their time to maturity might only differ by a few months, but their market price can diverge significantly purely because of this preference for liquidity.
And that divergence has a name. It's the liquidity premium. The on-the-run security trades at a slightly higher price, which means it has a slightly lower yield than its off-the-run twin.
And that premium is the cost the market is willing to pay for that superior liquidity.
And fungibility and ease of use as collateral in the repo market, it's often really small. I mean, maybe just a few basis points of yield difference. But when you apply that to trillions of dollars, it becomes a massive, massive number.
So walk us through the actual process, the rolling process in practice. Let's use the 30-year Treasury example. How does an investor capture that liquidity while still maintaining their constant maturity?
Okay, so it starts with the investor holding the current benchmark. Step 1, they buy the existing on-the-run 30-year Treasury. They're happy. They have the most liquid asset of its kind.
But the clock is ticking, and the market knows the exact moment this is all going to change.
It does. So, step 2. A new 30-year auction happens. The Treasury issues a new bond, and it immediately takes the title of on the run. The old bond, in that instant, becomes off the run.
And this is the trigger. This is what activates that constant maturity mandate.
Step 3. The investor executes the roll. They sell the old Treasury, which is now off the run. They're getting out of the contract whose liquidity is about to decline.
And then step 4, they immediately purchase the new on-the-run Treasury.
Right. They're trading into the contract that now has the highest liquidity and will be the preferred collateral asset for the entire next issuance cycle.
And the primary motivation for all of this institutional churning, I mean, despite the transaction costs, is just that liquidity is king.
It's all about optionality and collateral. That's really the bottom line. The on-the-run security is the easiest asset to deliver for margin requirements. It's the easiest to use in repurchase agreements repos to finance your other positions, and it's the simplest to short if you're hedging.
So its superior liquidity makes it the preferred tool for leverage.
That's right. And investors are willing to pay that liquidity premium. They're willing to accept a slightly lower yield because it reduces their financing costs and it enhances their operational flexibility.
Okay, but if the existence of this liquidity premium is so predictable, I mean, everyone knows the old bond will get cheaper relative to the new one right after the auction. Why hasn't high-frequency trading or some kind of institutional arbitrage completely erased this phenomenon?
That is a critical question. And the reason it persists is, well, it's about volume and execution risk. The liquidity premium has created this very popular and widely executed strategy called the Treasury basis trade.
The basis trade?
Yeah, or sometimes the roll basis trade. It involves doing two things at once: buying the relatively cheap off-the-run bond and shorting the relatively expensive on-the-run bond. The arbitrage is based on the idea that over time, the spread between those two will converge.
Or that the financing costs will allow the trade to profit from the mispricing.
Exactly. So funds are actively trying to exploit the very liquidity difference that the roll itself creates. They're betting on this predictable price movement.
But it's not a free lunch.
Not at all. Executing this trade at scale is immensely challenging. The index roll is a massive, concentrated movement of capital, and liquidity in the repo market, which is where the financing for the trade happens, that liquidity can just evaporate during periods of stress.
So there's funding risk.
There is huge liquidity risk or funding risk, and that's why the premium and the arbitrage opportunity persists. The arbitrage exists, but it is definitely not risk-free, especially given the scale at which major hedge funds are trying to execute this basis trade.
So it's the sheer transactional tidal wave created by all these synchronized institutional mandates that keeps the market from being perfectly efficient in that little window of time.
That's a perfect way to put it.
And the market observation from our sources backs this up. It says there is generally very high trading activity on these days, as contracts whose maturity falls on them are rolled. That high activity is the physical proof of both the constant maturity mandate and the basis trading that's trying to exploit the price distortions.
And that volume spike, it signals enormous synchronization. I mean, think of a major pension fund. Let's say it has a mandate to maintain $100 billion in a constant duration position.
Okay.
When that treasury auction occurs, that fund has to sell $100 billion of the old bond and buy $100 billion of the new bond, often within hours. And when you have hundreds of funds like that all acting at the same time, the market has to absorb hundreds of billions of dollars in coordinated selling and buying pressure. That's why the roll dates are consistently among the highest volume days for those specific maturities.
This concentrated burst of volume and the price distortion it causes, that on-the-run premium, it sets the perfect stage for our next section, where individual strategy scales up and creates systemic market effects. We're moving from a single fund's decision to, well, to the predictable market chaos of congestion.
That's right. The treasury market is a really clear example, but this roll mechanism is arguably even more critical and dramatic in the derivatives world, specifically in commodities and financial futures. And that brings us to Section 3, index roll congestion, anticipating high volume.
So we're shifting from an individual strategy to these broader market forces. And here, the predictability of the roll isn't just a function of government auctions, but a function of the published public methodology of major financial indexes.
This is so important to understand. When a big index like the S&P GSCI for commodities or the Bloomberg Commodity Index, when it holds futures contracts, it has to manage their expiration.
Because futures contracts expire, often every month or every quarter.
They have strict short-term expiration dates. So the index has to roll its holdings to the next contract maturity just to maintain continuous exposure to whatever it's tracking, whether that's oil or gold or a financial asset.
And the key factor here, the thing that creates the trading opportunity, is that the index's movements are totally transparent. So, explain the rules of the index.
Well, an index, for the sake of continuity and fairness and transparency to the trillions of dollars that are benchmarked against it, it often has a meticulously published policy for rolling its contracts. This policy dictates the exact days, or a precise period, say, the 5th to the 9th business day before expiration, during which the roll has to happen.
So this knowledge is public. It's basically a massive institutional announcement saying, hey, everyone, we're about to move X billion dollars between these two contracts on these exact days.
You've got it. It's like a massive oil tanker that announces it will be navigating a very narrow strait next Tuesday at noon.
And every speedboat and savvy tugboat captain knows exactly when and where to be.
That's an excellent analogy. The savvy trader strategy is to exploit this public knowledge. The proactive trading technique that arises is that investors choose to roll in advance of the index. They do their own constant maturity roll days, or sometimes even weeks, before the index even begins its mandated trading window.
Yeah, people call this front-running the index roll, right?
That's another term for it, yes.
So what's the tactical motivation? Why do this early? Why not just wait and save the transaction costs for a few days?
The motivation for moving early is purely driven by the anticipation of the index's trading volume and the market impact that it will inevitably create. Let's just visualize the flow of money. If a giant index is selling the nearby contract, that contract's price is going to face selling pressure. It's going to go down.
Right.
And if that same index is buying the next longest maturity contract, that contract's price will see buying pressure. It'll go up. This shifts the spread between the two contracts, what's called the roll, spread unfavorably for anyone who tries to execute the trade during that main index window.
Let's ground this in a hypothetical. Imagine a major index is tracking gold futures, and there's, say, $300 billion benchmarked against it.
Okay.
If the index policy says they have to roll, 10% of that position over a 4-day window, that means $30 billion of flow, $15 billion of selling one contract and $15 billion of buying the other has to get done.
Exactly. Now, if you are a pension fund managing, say, $500 million dollars and, $30 billion in flow is about to hit the market, you move early. If you wait, you risk executing your selling order at a lower price because of the index's systematic selling pressure, and you risk executing your buying order at a higher price because of the index's systematic buying pressure.
So by rolling early, you get a better price on that roll spread before the massive volume distorts the market.
You secure a better price. That's the entire game.
And this resulting market phenomenon, this crowding of traders into the pre-index window, this is what we call index roll congestion.
It is the systemic cost of predictability. Congestion happens because everybody anticipates the same massive flow, and everybody tries to move ahead of it. The index roll is this huge, almost mechanical transfer of liquidity. And traders are just trying to position themselves to either benefit from or simply avoid the costs of that transfer. It creates a period of intense, concentrated volume in the days right before the official index roll period.
So this preemptive trading, it really forces us to analyze the significance of congestion.
Hmm.
I mean, why does the anticipation of volume create this period of congestion that is costly and volatile? Why doesn't the market just smoothly absorb the knowledge of the upcoming trade?
And that highlights a really important distinction between informational efficiency and transactional efficiency. The market is informationally efficient. Everyone knows the index rule is coming. But it is transactionally inefficient because of the sheer size of the flow and the index's totally inflexible mandate.
The index must execute, regardless of the price.
Regardless of the price. And traders know this is a temporary artificial price distortion. It's caused by mandated flow, not by some fundamental change in the market value of oil or gold.
So the congestion is really the market temporarily front-running itself, and the early movers are the ones who are capturing that predictable transient inefficiency.
Yes. The very presence of congestion is powerful proof that the index flow is big enough to materially move prices. This dynamic makes the roll period a crucial and often very volatile time for futures traders. They'll adjust their short-term positions, those basis trades and arbitrage plays we talked about, specifically to capture the temporary widening or narrowing of the roll spread that happens during congestion.
And the cost of this inefficiency, which must be measured in hundreds of millions of dollars,
It
is effectively transferred from the passive funds that are just tracking the index to the active traders who front-run the roll.
That's the transfer of wealth right there.
This really shows the paradox we hinted at earlier. The institutional need for stability and consistency, that constant maturity mandate, is the very thing that creates these periodic, almost violent bursts of concentrated trading volume and market instability. It's stability creating instability.
It is the ultimate irony of market structure, isn't it? Stability in your portfolio mandate requires mechanical, rules-based action. And rules-based action at massive scale creates predictable dislocations that are immediately exploited by opportunistic traders. Understanding the timing of the roll, whether it's the predictable treasury auction or that transparent futures index schedule, is the key to understanding those temporary volatility spikes you see in these sophisticated markets.
We've covered a huge amount of ground here. We've moved from the mathematical necessity of constant duration all the way to the systematic strategy of index front-running. So it's time for our final synthesis. So what does this all mean?
Well, we've established that two-part mechanism of the rule. You're selling the expiring or nearby contract and you're buying the next longest maturity, and this is all performed to achieve stability in duration and your risk profile.
And we know the two big drivers. First, there's that specialized requirement to target a standardized benchmark, like the very liquid 5-year CDS rate. And second, there's that relentless institutional desire to hold the most liquid asset possible, which is perfectly illustrated by the US Treasuries on-the-run premium. That premium encourages constant rolling, even with transaction costs.
And critically, this strategy, when it's executed by these large rules-based indexes, it transforms the role from a simple administrative task into a multi-billion-dollar trading event. And the transparency of these mandates, that leads directly to index roll congestion, where active traders try to preempt the index's flow just to capture better prices, creating predictable volatility in the process.
So what does this all mean for you? Well, it means that if you're watching trading activity and you see these massive concentrated spikes in volume for specific futures contracts or specific treasury bonds on these highly predictable dates, you are very likely witnessing the constant maturity roll and the resulting index congestion in real time. This is systematic, mandated trading. It's not organic, fundamental trading based on new information.
And this raises a really important question. We saw that rolling, while it's a strategy for consistency, it actually introduces this transient volatility. But the concept of extending a financial position isn't limited just to futures and government debt, is it? How do other areas of finance implement this idea of position extension, and what unique risks do they face?
That's a great thought to build on. Our sources highlighted a couple of related concepts that show how this core principle of rolling applies to other, even more complex instruments. So for you, the listener, you need to be familiar with how this core idea evolves.
And the first one they noted was the jelly roll in the world of options. And this is where the concept moves far beyond a simple sell and buy mechanic.
A jelly roll. Okay, explain how rolling applies to a complex options strategy like that. What are the legs of this complex spread?
A jelly roll is actually a highly sophisticated four-legged strategy. It's a type of calendar spread that involves four different options contracts. Typically, it involves selling a near-dated option spread, so that's a call and a put at certain strikes, and at the same time, buying a longer-dated options spread at the exact same strikes.
So you might sell a January call-put combination and then buy the same call-put combination, but for, say, June.
Precisely. So you're effectively rolling an entire options position, both your upside and your downside exposure, from one maturity to the next. And often the goal is to lock in a profit or to maintain a specific risk profile without actually closing the position and creating a taxable event.
So it's a way to extend the life of the trade.
It is. It's often structured as a zero-cost transaction, or even one where you receive a small credit. The goal is to extend the life of a profitable position, or maybe a risk hedge, by using the money you get from the near-dated options to fund the purchase of the far-dated options. It uses the roll concept not just to maintain duration, but to specifically manage the time value decay, or theta, of the options position itself. It's a fascinating evolution of the basic constant maturity idea, but it's applied to volatility.
Okay, and the second related concept was rollover. Foreign exchange. How does this idea of extending maturity apply in the currency markets? They tend to have much shorter settlement periods.
Right. In FX, rollover refers to the process of extending the settlement date of a spot currency trade, typically from one day to the next. You see, Forex markets settle trades 2 business days after you execute them. It's called T+2. If a trader doesn't want the actual currency to settle, they don't want to take delivery of millions of euros, they have to roll the position over to the next day.
And that rollover, it isn't free, is it? There's an interest differential involved.
Absolutely. This is where the carry component comes into play. Every currency pair involves 2 different countries, and those 2 countries have 2 different short-term interest rates. When you roll a position, you are effectively borrowing one currency and lending the other for a single day.
So if the currency you're lending has a higher interest rate than the one you're borrowing,
You receive interest, that's called positive carry. If it's the reverse, you pay interest, that's negative carry. So the rollover process in FX is this continuous daily assessment of interest rate differentials, which makes it a critical cost or benefit for currency speculators and hedgers alike.
So whether we are looking at a 30-year Treasury bond, a 5-year CDS contract, a complex option spread like a jelly roll, or even a simple spot FX trade, the principle remains constant. Time moves forward, and financial mandates require active management to maintain a consistent exposure or duration or cost profile. And the resulting actions drive predictable trading behavior.
It is the financial world's way of saying, time changes everything, but we will constantly reset the clock to maintain our strategy. And understanding when and how and why the largest players in the world hit that reset button is absolutely fundamental to mastering modern market mechanics.
We hope this deep dive into the world of rolling contracts, constant maturity, and index roll congestion gives you, the learner, the competitive advantage that you are looking for. Continue your investigation into how time and liquidity shape these complex financial markets.
We'll see you on the next deep dive.